In recent years, the topic of negative interest rates has become increasingly relevant in the world of economics. But what exactly are negative interest rates? In simple terms, negative interest rates refer to a situation where the central bank charges banks for holding their money rather than paying them interest. This is in contrast to traditional interest rates, where banks are paid a percentage of the money they hold. The reason why negative interest rates have become a topic of discussion is that many central banks around the world are now implementing them in an effort to stimulate economic growth. As the global economy continues to face challenges, policymakers are looking for new ways to boost economic activity and prevent deflation. Negative interest rates are one of the tools they're using to achieve this. In this video, we'll take a closer look at negative interest rates and explore their implications on the global economy. Negative interest rates work by essentially reversing the traditional role of interest rates. Instead of banks earning interest on the money they hold, they are charged a fee, or penalty rate, by the central bank. This penalty rate is passed on to consumers in the form of negative interest rates on their savings accounts. The idea behind negative interest rates is to encourage banks to lend money rather than hoarding it. By charging a penalty for holding cash, banks are incentivized to lend out their money in order to avoid the penalty. This, in turn, should lead to more borrowing and spending, and therefore, more economic activity. Negative interest rates also affect bond yields, which in turn affects borrowing rates for companies and individuals. Lower bond yields mean lower borrowing costs, which should encourage more investment and spending. However, it's important to note that there are potential consequences to negative interest rates. For example, if negative interest rates become the norm, it could discourage people from saving their money and instead encourage them to spend it all, which could lead to inflation. Additionally, negative interest rates can also hurt banks' profitability, which could lead to a reduction in lending. It is also worth mentioning that negative interest rates have not been extensively tested and implemented, and their long-term effects are still uncertain. There are a few real-world examples of countries that have implemented negative interest rates in recent years. One example is Japan. The Bank of Japan, BOJ, introduced negative interest rates in 2016 as part of its efforts to stimulate economic growth and combat deflation. The BOJ set a negative interest rate of -0.1% on a portion of the deposits held by commercial banks at the central bank. The idea behind this policy was to encourage banks to lend more money instead of holding it with the central bank. However, the overall impact of this policy on Japan's economy has been mixed. While it did help to weaken the yen and boost exports, it did not lead to a significant increase in inflation or economic growth. Another example is the European Central Bank, ECB. In 2014, the ECB introduced negative interest rates on deposits held by commercial banks at the central bank. This policy was aimed at encouraging banks to lend more money to businesses and households in order to stimulate economic growth and combat deflation. However, the policy has had limited success in achieving these goals. It's worth noting that, while some countries have implemented negative interest rates, the effects on their economies have been mixed, and it's still uncertain what the long-term effects of negative interest rates will be. Negative interest rates have the potential to have a wide range of implications on the global economy. One of the main concerns is that negative interest rates could lead to inflation. By charging banks for holding money, negative interest rates could discourage saving and encourage spending, which could lead to an increase in prices. Additionally, if negative interest rates lead to an increase in borrowing and spending, it could lead to an increase in demand for goods and services, which could also drive up prices. Another concern is that negative interest rates could lead to deflation. If negative interest rates discourage borrowing and spending, it could lead to a decrease in demand for goods and services, which could cause prices to fall. Additionally, if negative interest rates lead to a decrease in bank profitability, it could lead to a reduction in lending, which could further slow economic activity. Negative interest rates can also have an impact on the financial sector. Banks' profitability could be affected, as they are charged for keeping money with the central bank, which could lead to a reduction in lending. This, in turn, could hurt economic growth. Another potential implication of negative interest rates is that they could exacerbate income and wealth inequality. Negative interest rates would be beneficial for borrowers but could hurt savers and retirees who rely on interest income from their savings. Overall, negative interest rates are a complex and untested tool, and their long-term implications are uncertain. While they have the potential to boost economic growth, they also have the potential to create new problems and challenges. In conclusion, negative interest rates are a relatively new and untested tool that central banks are using to try and stimulate economic growth. They work by reversing the traditional role of interest rates, by charging banks for holding money rather than paying them interest. This is intended to encourage banks to lend more money rather than hoarding it. We've seen real-world examples of countries such as Japan and Europe implementing negative interest rates, but the effects on their economies have been mixed. While negative interest rates can have the potential to boost economic growth, they also have the potential to create new problems and challenges, such as inflation or deflation, impact on banks' profitability, exacerbation of income and wealth inequality, and even discourage people from saving. It's important to note that negative interest rates are a complex and untested tool, and their long-term implications are uncertain.